All right, welcome to Oceanside Library. I'd now like to introduce our presenter, Daniel G. Mazzola, CFA and CPA from American Portfolio Financial Services, speaking to us about smarter Social Security. Thank you, Dan.
Okay. Thank you, Akari. Very happy to be here. My name is Daniel Mazzola. I see we have one person on the call, Patty. Patty, can you
Yes, sorry, I had to unmute.
Patty?
Yes, I'm here.
Oh, good.
I just had to unmute, sorry.
Did you have anything special about Social Security? Anything in particular you wanted me to go through tonight?
I'm just going to be, I guess, just over the cusp of being eligible now. So I just kind of wanted to hear what you had to say about what factors to consider in terms of when to start taking it, and things like that.
Okay. Are you married or are you
No spouse involved, correct?
There's no spouse involved, it's just you.
Correct.
Okay, so I'll just gear the program to you as opposed to the general program, which sometimes has, we spend a lot of time on spousal and survivor benefits, but that's not applicable to your situation.
That's right. That would be great. I benefit by that. That's great.
Okay, so then let's.
Thank you.
Okay, my pleasure. My name is Daniel Mazzola. The name of the class is Smarter Social Security. I do not work for the government. I do not work for Social Security. I'm my client's first call for financial advice and to get things done. When they have when they get a letter from the IRS, they give me a call. When they're ready to roll over that 401k plan, they give me a call. When they're ready to apply for Social Security, they give me a call and I will go down to the local office with them, make sure that they're getting the proper information and making the right choices. A few years ago, I went to a presentation on Social Security. The woman did a very good job, but she glossed over the spousal and the survivor benefits, which to me was the most interesting part of her presentation. So I developed my own, and here I am tonight. I try to give this class as often as I can because I think that people have a general lack of understanding when it comes to Social Security, leads them to make a lot of bad decisions as to what to claim, when to claim, leaving thousands and thousands and thousands of dollars on the table. First part of the presentation, I'm going to give a broad overview of Social Security. Second half, we'll spend our time on particular situations. So Patty, again, since you're the only one in the audience, if you have any questions or if I go through something a little too quickly for you, just say, hey, listen, can we go over that a little bit more slowly? As I said, I'd rather gear this to you as somebody who's out there.
Great, thank you.
All right. Good.
And Dan, I'll let you know if anyone else logs on.
Good. Terrific.
Okay.
All right, so a little bit of background about Social Security. Otto von Bismarck, who created the modern state of Germany, as we know it, developed a system for Social Security for the industrial workers of Germany during the late 19th century. In this country, the Social Security Act signed into law in 1935, creating a program designed to pay people 65 and older a continuing stream of income to last them the rest of their lives, not a lump sum payment, but a continuing stream of income to last them the rest of their lives. Interesting to note that the average life expectancy of an American at this time was only 61, so they didn't expect a lot of people to benefit from the program. This is a picture of Ida Fuller, recognized as the first person to collect a monthly Social Security benefit check. She was born in 1874, started paying payroll taxes in 1937. She contributed $24.75 during the 3 years she was enrolled. She retired in 1940, collected almost $23,000 until she died in 1975. So it was a fairly good return on her investment. 1935, the poverty rate for seniors in this country exceeded 50%. Today is less than 10%. Social Security represents at least half of the income for 53% of married, 74% of unmarried individuals 65 and older. So it's an incredibly important program in terms of the sustenance it's providing, as well as the amount of money it's pumping into the economy each and every year. Social Security is a pay-as-you-go system. That means money comes in, money goes out. Money comes in through the payroll tax dollars that you pay and your employer matches. Those payroll tax dollars used to pay the benefits for current retirees. Benefits of today's workers will be funded by the workers of tomorrow. So if you have not started collecting Social Security, your benefits will be paid by the workers of the future. The money that you put into the system today does not go into a separate account bearing your name, maybe like an IRA, but it goes into the General Trust Fund of the United States very briefly, and then comes right out again to pay the benefits for people who are collecting. Money comes in, money goes out. Changing demographics, in 1935, the worker beneficiary ratio was 160 to 1. That means there was 160 people putting into the system for every one person taking out. Today is about 2.8 workers for each beneficiary. By 2033, there are projected to be only 2.1 workers for each beneficiary. A lot more people taking money out of the system. It's going to lead to some problems. The trust fund, by 2033, the trust fund reserves are projected to be exhausted. At that time, payroll tax revenues will cover only 3/4 of currently legislated benefits. So something's going to have to happen between now and 2033. But I get this question all the time. I'm retiring next month, next year. Should I be worried? The answer is no. We're in good shape until 2033. There are 3 things they could do to close the gap. Number 1, they can raise the full retirement age. Everybody on the call tonight, full retirement age is between 66 and 67. So they could raise that to 68 or 70 or 72. Number 1. And number 2, they could raise the taxable wage base. For Social Security purposes, you're only taxed on your first $137,700 in 2020. For Medicare purposes, you're taxed on every dollar. So they could raise that to 140, 150. It's been going up every year, the last few years, pretty significantly, but who's to say they can't raise it by even a higher standard? And finally, they could raise the payroll tax rate. You pay 6.2% of your wages into the Social Security system. That's matched by your employer. And again, they could raise that to 7.2 or 8.2. So there are definitely ways they could fix the system, close the gap. It's going to take a politician or a group of politicians to step up and say, hey, we have to do this now, not in 5 years or not in 10 years. But they really don't talk about closing the gap. And if they talk about anything, it's expanding Social Security benefits for other people. But we don't talk about public policy in my class. That's not why we're here tonight. All right, important slide. For the purposes of this class, when I say full retirement age, I mean 66. That's for people who were born between 1943 and 1954. Their full retirement age is 66. If you were born after 1954, you have a slightly higher full retirement age. So if you were born in 1958, your full retirement age is 66 and 8 months. If you were born in 1960, you have a full retirement age of 67, okay? But all the 66 is the number that I will use for full retirement age. All the examples and projections, scenarios, et cetera, are based on a full retirement age of 66. All right, this is an important slide coming up, Patty. Okay, very important slide. Doesn't mean you have to wait until 66 to begin collecting. You could start as early as 62. The amount that you claim, however, will be reduced. So if my benefit is $1,000 per month at age 66, my full retirement age, but I want to start as early as I can, which is at age 62, I'm only going to receive 75% of that amount. And that lowered amount is the amount that I receive for the rest of my life. All right, so very important. So you want to start claiming Social Security early, that's fine. A, your amount is going to be reduced, and B, it's going to be reduced for the rest of your life. You don't get a bump up when you turn full retirement age. There's another condition, concern about collecting early before full retirement age. We'll get to that in a moment. All right, but I think this is very important. So you can claim Social Security as early as 62. The amount that you claim will be reduced, and it will be reduced for the rest of your life. All right. Each month that you wait until after 62 goes up a little bit. So I had at 63, you're at 80%, 64, 86 and 2/3, and so on. If you can afford to delay collecting Social Security, I'm a big fan of delaying as long as you can, provided you have the means to do so. You get a 2/3 of 1% increase each month, which rounds up to a nice 8% each year. So at 67, you're going to get 108%, 68, 116%. At age 70, you're getting almost an extra third, 132%. No point in waiting till after age 70 because the delayed credits stop. All right. So the latest you want to collect Social Security is at age 70. You're getting almost an extra third of the amount had you collected at full retirement age. Is this understandable, Patty? Do you understand this? Again, very important slide.
Yes, I'm already familiar with this. Yes.
Good. Okay, terrific. Okay.
Great, thanks.
As I said, I'm a big fan of waiting as long as you can, provided you have the means to do so. If you have to take Social Security at 62, that's fine. But if you have other resources and an IRA account or money in a brokerage account or whatever, you should be looking at that rather than taking Social Security. And we'll get to that in a little bit more detail as we go on. All right. Is there an actuary in the house? Well, unless Patty's an actuary, there's no actuaries in the audience unless a carrier is doing actuarial business on the site. All right.
Got it.
From an actuarial perspective, it does not matter when you begin collecting if you live to your average life expectancy. Let's say average life expectancy is 80. All right. So if you know that you're not going to make it to 80, it doesn't matter when you start collecting. It'll be the same aggregate amount at 62, 65, 68. It doesn't matter. It doesn't matter. You have to live past your average life expectancy for the decision to delay to be the right decision. All right. So if you know you're not going to make it to 80, again, turn off the screen right now. Go watch TV, read a book, whatever you want to do. This class does not matter to you. You have to live past your average life expectancy for the decision to delay to be the right decision. Okay. Most of us don't know whether or not we're going to make it to 80. So it's usually a good idea to wait just in case. All right. I get into this question all the time. People want to take Social Security as early as they can so they can enjoy the money, to the break-even age, all these reasons. That's fine. But I'm a big fan of waiting. You don't know what your life is going to happen. You don't know how long you're going to live. I would suggest you're going to live a long life and you want to delay Social Security to help pay for those medical expenses. We'll get into that in a moment. All right.
So bottom line is, as long as you don't need the money now or in the next few years, wait until you're 70 to take it.
Well, wait as long as you can.
Right.
I mean, I have a client who's at full retirement age. She's still working as a school counselor. She has a nice salary. She likes her job. She intends on working for at least another year or two. She can take Social Security, but my advice to her is you don't need the money. Why take it now? Each month that you delay, it goes up. Each year that you delay, it goes up 8%. So if you're in a position, Patty, to wait, I suggest waiting because there are benefits to waiting. We'll get into that in a little bit. Obviously, if you have to take the money for whatever reason, by all means. But I think if you're in a position to wait, you should wait. Does that make sense?
Yes, it does. Thank you.
Good. Okay. This is why you should wait. Social Security is a form of longevity insurance. Longevity is the biggest driver of healthcare costs. It's not how healthy you are, it's how long you live. If you live a long life, you're going to incur a lot more in medical expenses. By waiting to claim Social Security, you're buying more longevity insurance, the protection against the financial challenges of living longer than anticipated, living longer than your life expectancy. The lane provides greater income at an advanced age when healthcare expenses will increase rapidly. Your healthcare expenses are going to increase rapidly, mid-70s, late 70s, and beyond. Unless you have health insurance from a job and you're relying on Medicare or something like that, you're going to have a lot of out-of-pocket costs. And these out-of-pocket costs are only going to get higher and higher and higher. As you live longer, you're going to have more medical expenses. You're going to need that extra Social Security to cover those medical expenses. Are you in a position, Patty, where you'll have health insurance through a job or something like that for the rest of your life?
Yes, right now I'm collecting retirement health benefits, and then soon I start on Medicare.
Okay, so the retirement health benefits will end, I guess, when you leave employment?
I retired about 10 years ago. I retired early. I retired about 10 years ago.
So at some point, you'll have to rely on Medicare.
Next year, I start Medicare, yes.
Okay, good. Okay, so let's look at the Medicare cost. Right now, a 65-year-old couple enrolled in Medicare will pay at least $10,300 this year in premiums and out-of-pocket costs. All right, so as a single person, Patty, just take that number divided by 2. So this year, if you were enrolled in Medicare, you'd probably pay about $5,000 in premiums, out-of-pocket costs. There's a Medicare a webinar coming up next week, I guess, or Carrie said soon to be. So those Medicare, I don't think people appreciate how expensive Medicare it is. It doesn't cover everything. It has copays, premiums, lots of different costs. So people go into Medicare thinking, well, it's going to cover everything. What do I need Social Security to help me cover medical expenses? That is a falsehood. Okay, you're going to need extra Social Security to cover Medicare. This Medicare expenses are only going to go up. Medicare expenses are not going to go down. If anything, they could skyrocket depending on what happens next Tuesday. All right, so you're going to need extra money to cover Medicare costs.
Yeah, I'm painfully aware of that, and should have appreciated how good I've had it, and I didn't appreciate it as much as I should have. But
Yes. I don't think people, until I started teaching this class, I didn't realize how expensive Medicare was, A, and B, a lot of things that Medicare doesn't cover. Right now, there's a lot of commercials on these Medicare Advantage plans and how good they are in terms of covering dental and vision and hearing and all those kind of things. Traditional Medicare does not cover that. So if you get a traditional Medicare policy and you have to get glasses or hearing aids or go see a dentist about dental care, that is not covered by Medicare. Where are those costs coming from? It's coming from your pocket. All right. So I don't think people appreciate that. And that's really where the delaying Social Security comes in. It's going to help you cover these increased medical expenses as you get older and older and older. Those expenses are only going to increase at a rapid rate. All right, loss of benefits due to excess earned income. We talked about how important full retirement age. Full retirement age is very important in terms of the amount of benefits that you can collect, but also in terms of this earnings test that applies. At full retirement age, no benefits are lost due to employment wages, all right? So you're at full retirement age, you make as much money as you want, you work as much money as you want, no benefits are lost due to employment wages. However, if you are collecting Social Security before full retirement age, you can lose some of all the benefits by working. This includes spousal and survivor benefits. All right, so Patty, I know this doesn't apply to you. Just be aware, though, that if you were collecting as a spouse or a survivor, if anybody you know is in that position, the earnings test applies to them just as well. So what is the earnings test? For wages earned before the year the beneficiary reaches full retirement age, $1 of benefits is lost for every $2 over an $18,000 threshold. So let's look at an example. We have a 62-year-old. This is a 62-year-old, 4 years before full retirement age. He's still working. He's making $40,000 a year in wages. There's the threshold, $18,240. You take the difference, you divide it by 2, and you're left with $10,880. What this means is that unless this person is collecting more than $10,880 in Social Security, he won't collect anything. All his benefits will be withheld from him. All right. As you can see, it doesn't make a lot. It doesn't take a lot in earned income, wage income, for you to go way above the threshold and have your benefits cut. All right. So Patty, you said that you have not reached the full retirement age just yet, correct?
that's correct.
Okay. You're still working though?
No, I retired about 10 years ago.
Okay, good. Okay, so the earnings test doesn't apply to you, so we're going to skip this as well. Just be aware, though, if for some reason you did go back to collect, start working again, and were collecting before full retirement age, there would be an earnings test. After full retirement age, no earnings test at all. Okay?
Got it.
All right, so I'm going to skip this. All right, let's talk about how my benefit is calculated. Retirement benefit is based on a worker's highest 35 years of earnings inflated for economy-wide wage growth. Not the first 35, not the last 35. It's not even consecutive 35, but you want to have 35 years of earnings. You want to have a full earnings history, okay? So if you have, let's say you only have 30 years or 32 years, you're going to have zeros in your earnings history. It's going to bring down your benefit. Patty, may I ask how many years of your earnings history do you know you have, or any idea?
Yes, actually, I kind of screwed myself not realizing it when I retired at 54. So I do not have 35 years of work history. I probably have about 33, but a few of those on the early side include like just working summers during college. So my income was very low. I assume the income 30 years ago gets adjusted for cost of living over the years, but I don't know how much, but I have some very low numbers
Exactly. And
included in my 32 or 33.
you're absolutely right. So those early years are inflated for economy-wide wage growth. That's what that part of the slide means. So your earnings from 1985 or 1983, whatever it is, they are inflated for economy-wide wage growth. That's what it'll be based on. Not a dollar amount, but that revised upward amount. Okay?
Okay.
All right. So I'm going to skip over this. Okay, so let's go back to the reasons to delay. People tend to underestimate their life expectancy. 65-year-old has a 1 in 3 chance of living to 90. As adults live longer, they are more likely to live with multiple chronic conditions, functional limitations resulting in higher spending on healthcare needs. Again, your healthcare expenses are going to increase rapidly. So if you need Social Security to cover your basic living expenses, well, I understand that's one thing. But if you have other sources of income, I strongly suggest waiting. You're going to need that extra Social Security benefit, that enhanced benefit, much more at an advanced age. All right. Survivor benefits, reflected late credits. This is really for couples. And again, this is for spousal benefits. So we'll skip that. Okay. So normally I get some common questions at this time. How can I obtain the amount of my Social Security benefit? Patty, do you have a copy of your Social Security statement?
Not with me right now, but I do have an account on the Social Security website.
Good,
Yes.
okay, that's terrific. That's very important. I meet a lot of people when we do retirement planning. The first question I ask them is, do you have a Social Security statement? And they say no. And I say, okay, well, we have to reschedule our meeting. You want to have the Social Security statement. It's very easy to get. It should take you more than 15 or 20 minutes to upload your Social Security number, all that kind of other information they're going to need, and then you'll have access to your statement forever and ever and ever. So I highly encourage people. You've already done it. Congratulations. If you have not done it, go on to the website, socialsecurity.gov/myaccount. Get that statement so you know what you have to plan for your retirement. All right. Can I collect and change my mind? You are allowed a do-over. So let's say you start taking Social Security, and for some reason you change your mind, you'd have to give all the money back. You just have to pay all the money back. You're allowed to do this once per lifetime, and it must be done within 12 months of the initial collection date. All right, so you are allowed effectively a do-over. You would just have to give all the money back. This has come up a little bit more frequently the last 6 or 7 months I've given this presentation. People lose their jobs, unfortunately. Here's a way to take Social Security. And then if they find a job 6 months, 8 months, whatever it is, as long as it's within a year, they're allowed to put the money back and then start over again as though it never happened. So
that's without penalty then.
Without penalty, right? There's no penalty. You just have to give all the money back, and you're allowed to do this only once per lifetime. But there's no penalty involved. It's like it never happened.
Okay.
All right. All right. Is Social Security taxable? Yes, it is. Depending on what your other sources of income are, it could be 50% benefit subject to tax liability or 85%. Doesn't mean it's taxed at those rates. It just means it's subject to 50%. So let's say, Patty, as a single person, you have income over $34,000. That's adjusted gross income. Okay. What they would do is they would take your Social Security, half of your Social Security plus the adjusted gross income. And if it comes in over 34,000, 85% of it is subject to tax liability. So a good rule of thumb I like to use, unless Social Security is your only source of income, it's highly likely it will be taxable. Okay?
Okay.
Again, only source of income. If you have anything else, whether it's wages or IRAs, pensions, money in the bank, whatever it is, there's a good chance Social Security will be taxable.
Got it, unfortunately.
Let's skip that. Okay, how does the age at which I claim Social Security affect my Medicare? You said you have not started collecting Medicare, correct?
That's correct.
All right, good. So let's talk about Medicare. This part of the presentation, I think, pertains especially to you. All right, so let's say that you have decided to take Social Security. At 65, you're automatically enrolled in the Medicare program. Congratulations. Okay. But let's say you have decided not to take Social Security for whatever reason. You want to make sure that you sign up for Medicare at 65 on time. All right. If you don't sign up for Medicare at 65 on time, then there are late enrollment penalties that last your entire life and gaps in coverage. Okay, so please be aware of this. I don't think people appreciate how Medicare works, how it interacts with Social Security, and the fact that if they don't sign up for Medicare on time, guess what? Late enrollment penalties last your entire life, not a year or two, your entire life. Also, gaps in coverage. Maybe you miss the enrollment period and there's 3 or 4 months where you don't have Medicare. That's the time that you get sick, you get hit, get into an accident, whatever it is. Now you don't have Medicare, you're stuck. So you want to make sure that you sign up for Medicare on time, which is age 65. You have 3 months before and 3 months after. Okay, so please be aware of this, Patty. Again, if you're in a situation where you have to sign up for Medicare, you want to sign up at 65, either 3 months, the window, it's a 7-month window. You have 3 months before, 3 months after. Does that make sense?
Does, yes.
Good. All right. A little bit more about Medicare. Part A Medicare, which is hospitalization, is free. So there's no reason why you would sign up for Part A Medicare. Part B, however, is going to cost you something. So you have to decide whether or not you need Part B. Okay, so you should enroll for Part B at 65 unless you or a spouse are actively employed for a company with more than 20 employees. So this doesn't apply to you, Patty. So you want to make sure that you sign up for Part B Medicare on time, age 65, 3 months before, 3 months after. If you don't, there's a late enrollment period for Part B, which lasts your entire life.
Got it.
If you get anything from my class tonight, Patty, please be sure that you sign up for Medicare on time, which means age 65, okay?
Okay, got it. Thank you.
All right. So common misconceptions about Medicare. Medicare is free, Medicare is not free. This is some of the deductibles that apply to Part A. You can see you're paying a deductible from day one. So maybe you have a Medicare, you're in the hospital for a couple of days, a week, 2 weeks. Guess what? There's a $1,300 deductible, which means they're not paying all the costs. Where are you getting the money for that? A lot of people don't appreciate this. They think Medicare comes in, covers all your expenses. That's not the case. Part B, which is doctor services, monthly premiums start at $135, typically only pays 80% of the cost of approved services. Where's that other 20% coming from? It's coming from your pocket. So if you don't have money in the bank or an IRA account, you better make sure you have it from your Social Security. All right. So this is just Medicare. If you have any Medicare questions, you let me know. You give me a call. I have somebody who handles Medicare. That's all she does is Medicare. It's not something I specialize in. So you give me a call and I'd be happy to put you in touch with her.
Okay, thank. I do have a question, which is sort of unrelated to this, but you might have knowledge about it or not. If I could take advantage of the time and ask you, I have a health savings account because I have a high deductible medical insurance right now. I will have remaining funds in there by the time I start Medicare. Can I use the health savings account money to pay for Medicare Part B, Part D premiums? Or is it only for deductibles and et cetera?
That is a great question. And I have a health savings account too. I've been giving this class now 4 or 5 years. That's probably the first time I've asked that question. I think, and if you want, you can give me your name and number and I'll call you or contact you tomorrow. I'm pretty sure that your health savings account can be used for Medicare's premiums, but I'm going to write that down.
Okay, because I seem to find mixed things on the internet and nothing is conclusive, so.
Like I said, I give this class all the time, and that's the first time I've heard that. Okay.
Well, it's not really related. I understand why you wouldn't necessarily get the question, but I just realized I'm going to have, when I start Medicare, I'm going to have excess funds that I won't have used yet in my HSA account. So I'm just trying to understand, can I use it for premiums? And I'm hoping the answer is yes.
Okay. I'm going to say yes, but I am not absolutely 100% sure. So that's something that we will have to contact each other tomorrow or Friday, or I'll give you the answer for that. But that's a great.
Sounds good.
I have a health savings account myself. I always tell people that the beauty of the health savings account is that you can roll over the unused savings each year.
Right. Right.
And-
As opposed to an FSA. Yeah.
And there's no law, there's no rule that says you have to use the health savings account for your medical expenses. So you can treat it almost as though it's like an IRA account in the sense that you're putting money in, you're getting a deduction, you're getting tax-free buildup, and then you use it for retirement purposes, correct?
Right. Right.
Yeah. No,
Also, I just want to mention too, next Wednesday night, we do have that Medicare program, and it'll be only on Medicare. So maybe they may be able to answer the question as well. If you guys don't, after you contact each other, if you don't come to a solution.
great.
But yeah, if you want to learn more about Medicare, Patty, you can come next Wednesday night as well.
Great. Thank you.
No, that's terrific. As I said, I'm a big health savings account fan for those reasons that we talked about, the fact that you can roll over the unused amounts each year. And if you're funding it fully for a long time, you'd have a nice, another source of retirement income. It's like an IRA that you can use for medical expenses. If you don't have medical expenses, terrific, then it's a retirement savings account. So thank you very much for that question. We will square up on an answer, I promise you that.
Great. Thanks so much.
Okay, so the rest is, this is Medicare. I don't want to take more time talking about Medicare today, especially if a carrier is having somebody come in next week. Terrific. These are spousal benefits, so we'll skip this. Yeah, this is all spousal benefits. Okay. Divorced spouses benefit, this does not apply. Survivors benefit does not apply. Okay, so then I think I'm going to end with this segment, Patty, and then if you want, you can ask me some questions or we can exchange information. But I think this might apply in your situation, especially because you do have a health savings account. So here we have a question where we have a couple newly retired, approaching full retirement age. What bucket should they draw from to replace their wage income? Okay, so they're retired. They have money in an IRA account. They have money in a brokerage account. They have their Social Security. So this question calls up, all right, and you're kind of in the situation in that you have a health savings account, correct? Patty?
Oh, yeah. I'm sorry. I was muted. Yes, I do.
Okay, so you have do you have an IRA account by chance?
I do.
Good. You have an IRA account. You have a health savings account. Do you have a brokerage account?
I do.
Oh, all right. You're terrific. And then you have your Social Security. So you
Right.
have 4 different sources of retirement income.
Right. So I'm also facing, when do I start drawing from the IRA?
Okay, good. So then let's go over this now. I'm glad I have this section for the presentation. This is a good place to finish up, and then we can spend some time on this going forward. So here's a couple they have 3 different sources of retirement income. You're actually in a better position because you have 4 different sources of retirement income with your health savings account. So the question becomes, okay, where do we draw from first? Okay. A lot of people don't think they should be taking money out of their IRA account. They get the tax deferral. They say to themselves, I'm going to leave money in the IRA. I'm going to leave it in the IRA. And that could backfire you at some point in the future. Because what happens is at some point when you're 72 years old, and I know this is a couple years down the road from you, Patty, but nevertheless, I think you should start thinking about it. At 72, you have to make what's called a required minimum distribution from your IRA. And if you have a large IRA, that means you're going to have a large required minimum distribution. Works out to be about 4% of the account each year. So let's say you have $100,000 in your IRA. When you turn 72 and every year thereafter, you have to take out starting with $4,000, and that percentage goes up because your life expectancy goes down. Does that make sense?
Yeah.
Okay. So you take more money out of your IRA account, it's going to put you possibly into a higher tax bracket. It's going to increase your Medicare premiums. It's going to increase your Social Security benefits subject to taxation. It's going to reduce the deductibility of your medical expenses because you have a higher threshold. And depending on if you have a lot of money you might have a penalty on your net investment income. So the fact that you have an IRA account sounds great, but really isn't as you get older and older and you approach that age where you have to take what's called a required minimum distribution, which is age 72. All right.
Got
So
it.
I am a big fan, and we do this a lot in my office. We do something called a Roth IRA conversion. Have you ever heard of a Roth IRA conversion, Patty?
I actually converted some funds to a Roth IRA several years ago. So,
You're on the right path. And this is what you should be thinking about, doing this more and more. You can, if you're in a position to convert money from an IRA to a traditional IRA to a Roth IRA, I'm a big fan of this. Why? It's going to help you. It's going to cut down on your traditional IRA required minimum distribution, because as you know, from a Roth IRA, there's no required minimum distribution. You take the money out when you want to take it out. And if you don't want to take it out, you just leave it there. So we're big fans of Roth conversions. Roth conversion was in the account owner converts his traditional IRA to a Roth, assumes a current tax obligation for the control to decide for what amount and when to take withdrawals from retirement accounts. And that's the key word on that slide, control. You have control. The government doesn't have control. You have control. So you're assuming a current tax obligation, which might not sound too appealing now, but I can guarantee you, well, I can't guarantee you, but I can almost guarantee you that taxes were going to go up in the future. We have now a $5 or $6 trillion budget deficit. And somewhere down the road, whoever's the president is going to say, hey, you know what? We're going to have to raise your taxes to come back and cut down this deficit. So I can almost guarantee, I can't guarantee you, but I'd be, I think, foolish, or it would be imprudent for people not to think that taxes are going to go up in the future. And if that's the case, you should be doing Roth conversions now while you have the money, while you're in a lower tax bracket. And Patty, you already have this idea, so I'm not going to emphasize it too much. The only thing I would add is that if you're in a position to do more Roth conversions, whether it's this year, next year, whenever it is, take advantage. Take advantage of the lower tax brackets, the lower tax rates. Most assuredly, they will go up in the future. Okay?
Right. Interesting thought. Thank you. Yes.
Okay. The other thing I would mention is that a lot of people don't really appreciate how the long-term capital gains rate works. And if you're in a position where you have a long-term capital gains on a stock that you held, you said you have a brokerage account, Patty?
I do.
Okay. So there might be gains in there. You might be in a position to take some of those gains. Why? Because as a single person, depending on what your income is, you get a standard deduction of, well, this is for a couple, I apologize, but you get a standard deduction of about half of this, which is about $12,500. If your adjusted gross income is not that much higher than the standard deduction, you can take long-term capital gains up to $80,000 and not pay any tax on those gains. So this is for something that I'm a CPA, so I can help you out with this. If this is something that you're in a position to, again, look at your holdings in your portfolio, depending on what your adjusted gross income is, and depending on what the tax is on that income, you might be in a position to sell some of your stocks. Don't worry about the long-term capital gains. Why? Because, and this is for an adjusted, this is for a couple. So the long-term capital gains tax for you, Patty, would be half of that. But still, you can sell $40,000 worth of stocks at a gain and not pay taxes on them, or pay minimal taxes on them.
As long as my adjusted gross income is low.
Right. So depending on what your adjusted gross income is, they don't take your adjusted gross income and the capital gains and put it together. They separate it. And they lay the tax rates on one. They separate it. It's kind of like they break it in half. And because of that, you can kind of, I hate to say maneuver the system, but you might be in a position based on what your adjusted gross income is. If you're not paying a lot of taxes there, then you can add the capital gains taxes. And as long as it's under $40,000, Patty, that rate is 0%. So you're not paying any taxes on your capital gains below $40,000. So just keep this in mind. So if we go back to that slide where we started at the beginning, a lot of people say, well, I'm going to take my Social Security. Why? Because I'm going to pay taxes on the brokerage account. That's not necessarily the case. Depending on what your tax situation is, you might have capital gains and pay no taxes and use that money as a means of covering your expenses, leaving the Social Security for last.
Got it.
All right, so that's really the point of this part of the presentation. I think people, I see this way too often. They need money to replace wage income. They stop working. They say, okay, I'm going to take Social Security without looking at the tax consequences of taking money from or delaying it from a Roth IRA. I'm sorry, from a traditional IRA. I think you should be drawing that down now at your life a little bit each year, maybe, and using those capital gains. That fact that you can take $40,000 of capital gains, not pay any taxes on that. I think that's something that you should be certainly aware of and maybe take advantage of, depending on what your circumstances are. Okay?
Got it. Got it.
So that's really the end of the presentation. The whole idea is to integrate Social Security with your other assets, such as Roth conversions, to generate a tax-efficient stream of income that will span your lifetime. You have, in your situation, Patty, you have 4 different retirement accounts. You have the health savings account, brokerage account, traditional Roth IRA, and your Social Security. So at this stage, you should be planning, kind of putting everything together and saying, listen, where am I going to take from this year where it makes the most sense tax-wise and where it's going to put me in a position where I'll have these assets as long as I can, spanning my lifetime, hopefully spanning my lifetime.
Right. Right.
Okay. So what I would suggest, if you want, I could contact you about that question about the health savings account, or you can contact me. Here's my information, whatever you'd prefer.
All right. I'm going to record your information, whatever, and I will either email you or call you in the next couple of days.
Okay, great. So here's my
That's
address,
okay.
and here's my telephone number and my website.
That's great. But thank you. This has really been extremely informative, and I appreciate your customizing it for me to make it especially meaningful to me. So I really appreciate that.
Thank you very much. It's good to deal with. Sometimes I teach this class in front of a large group and I can't personalize it. And in this way, things get lost or people don't see it, how it appeals to their situation. Or in your case, again, I think with your different buckets, you have 4 different retirement buckets, at least 4. You might have other things. So you want to really put yourself in a position where, okay, I'm lining up my buckets each year. Where am I going to take from, knowing that Social Security, if I can afford to do so, and I think you can, I'm going to leave that for last. Why? Because I get that increase every year, an 8% increase every year, and don't have to take it unless I really have to. And I don't think, without knowing all the specifics, you're certainly not in a position where you have to take it.
Right.
Oh, thank you so much, Dan. Here, let me end the recording here.